Welcome to the Phronesis Partners podcast, Navigate with Confidence. In each episode, we sit down with our clients and other thought leaders to discuss how they and their own customers use insights and data to illuminate, validate, and navigate their paths to growth and competitive success. We welcome you to join us as we uncover and explore the unknown so that business leaders like you can navigate your own opportunities and challenges with speed, accuracy, and confidence. Welcome to Navigate with Confidence, the podcast where we explore how research and insights drive bold decisions and better outcomes. I'm your host, Elaine Pratt, and today I'm joined by Peter Witte, a director in EY's private equity practice. Pete leads global research and insights for EY's PE clients and recently spearheaded a landmark study, the EY Private Equity Value Creation Benchmark Survey. The study uncovers how top-performing firms are reshaping their value creation strategies in a more complex and competitive deal environment. It also marks a significant collaboration between EY and our team at Phronesis, who conducted the research and helped EY access a uniquely senior and specialized audience of deal and operating partners for the study. So Pete, welcome, and thank you for joining us today.
Well, Elaine, thanks so much for having me. I really appreciate the opportunity to share some of the insights from the study and the process that we went through, and really appreciated the opportunity to work with Phronesis on this.
Well, that's great. So, let's start with the big picture, Pete. What made this the right time for EY to conduct this study? And what were you hoping to uncover?
Yeah, so this is a piece of research that we've been contemplating for a while, and it's really around the various approaches that firms use for value creation, right? So, one of the defining characteristics in private equity over the last 20 years or so has really been the evolution of the operating partner role and the elevation of the importance of driving real operational value creation. So there's been this strong demand across our client base to really understand what's the range of models that are out there, and what are some of the best practices around this? And so, as a consulting firm, it's really been a question that we have, gotten from our clients on a pretty regular basis, right? Where some want to benchmark themselves against their peers. Others might be thinking about making some kind of a strategic shift, right? Maybe they want to scale up their business. Maybe they want to go the other direction and pursue some level of specialization. And they want to understand how that might impact their operating model. And so, as we got these questions, frankly, I think we kind of struggled to respond to them in a way that was fully satisfactory for us, right? We've got 25,000 folks that are out there working with private equity shops every day. We see a wide range of different approaches. And so we've always been able to answer things robustly from a qualitative perspective, but there wasn't necessarily a ton of rigor behind that. And so that's where the study came in, right? It was being able to quantify some of the things that we were seeing out in the market. And when we looked across the available literature out there, it wasn't something that was really broadly available either. And so we partnered up with Phronesis to undertake the research, and we think it's pretty unique in terms of, both where it's focused and the depth of the data that we were able to get.
And I understand that this audience was not an easy audience to reach. Senior deal professionals and operating partners can be tricky to access. So why was it important to hear from both of these groups, and how did the collaboration with Phronesis help you access that mix of professionals?
Yeah, I think that's one of the reasons that we don't see a wide range of research around this, right? Is that this is a tough group to really access and get insights from. And so, again, that's where working with Phronesis was so incredibly helpful here. PE is not like consumer products or technology or, one of these other sectors where, you've got where it's a huge sector, right? Private equity is a pretty small space, right? It's populated by folks that are incredibly busy. They tend to be well compensated. They don't necessarily have a ton of extra time on their hands. And when we did the research here, we were fairly specific in terms of the types of insights that we were really after, and the types of folks that were going to be able to provide those. We were looking for senior people that could speak on behalf of their firm's approach, and help us understand some of these best practices that are out there. And so we were looking for, deal professionals at these firms, and we were looking to speak to the operating partners as well. And so um, what we did here, we went out, we surveyed about 130 different private equity firms with more than $1 billion in assets. We think that it's pretty representative of the population of large firms that are out there. And working with you guys, we were able to access a global sample. About three-quarters of the study comes from North America and Europe, and then the rest was spread across the Middle East, Asia Pac, South America, and so on.
Can you just define what you mean by operating partner and today's PE environment, and perhaps how that role has evolved?
Yeah, for sure. I mean, and agree. It probably makes sense here to kind of step back and just take a look at what the role of the operating partner is and how that's kind of evolved and changed here over the years. If we think about, for example, the evolution of private equity in the asset class, and you rewind back 20 years, private equity was really made up of two different kinds of folks, right? There were the investment teams who led the investments, and they also took responsibility for working with the management teams very closely. And then there were sort of the back office functions, right, that helped raise capital. They worked with investors. They did a lot of the operational functions in terms of, keeping the GP running and those kinds of things, right? And that worked really well at the time because private equity was a relatively simple business, right? Your returns were driven by asset selection, right? So buying the right company in the right space at the right price, the right time. And it was driven by leverage, right? So optimizing the capital structure in a way that was going to help drive some of those equity returns. But what we saw over time is that as the asset class started to grow, as more competition came into this space, it became increasingly important to find other levers to pull to help, continue to drive those private equity-like returns. And that really came from operational value creation, right? And so they started to layer in operating partners to work alongside the deal teams, and some of the other enabling functions of the firm to help drive that operational value add. And it started off with a relatively simple model, right? So a firm, for example, might partner up with a retired CEO who knew the industry inside and out, had great networks, great experience in the sector, all those kinds of things. They would partner up with the CEO and, just be sort of a sounding board for the management team, right? And that model is still out there and it's still relatively prevalent. But we've also seen the expansion of the role over time, right? Where a firm might bring in functional experts, right? Folks who are experts in supply chain, for example, or pricing, or HR, or IT, all these different functional areas that cut across different types of portfolio companies, right? So many, but not all firms have started to layer in some of these types of folks into their model. And so fundamentally, that's really been what this study is about, right? What kind of models are out there, and what can these ops teams really learn from one another?
Yeah, in fact, in the report, you outline 5 distinct operating partner models, from traditionalists to interventionists. Uh, why is there no one-size-fits-all approach, and what should firms consider when defining their model?
Yeah, it's a great question. So I think, like you said, we did identify, 5 different archetypes here, right? And just a kind of a range of models here. And um, where some firms are going to have sort of a quarterback that is going to coordinate a bunch of external advisors. Others are going to have more of these functional resources that I talked about. But if you think about it, for example, as a spectrum, right? On one end, you've got these traditional models, right, where the operating team at the GP level, at the fund level, is pretty small, right? And you've got a handful of generalists, and they're able to pull in all of these external resources as needed. They can pursue best-in-class resources for whatever situation or issue they're trying to solve. And they're going to coordinate with these advisors as the deal goes on, right? The value creation levers here tend to be more bespoke, right? So they're not necessarily relying on a well-defined playbook in the same way that some of the other more interventionist type funds might. But that's sort of the approach at one end, right? And then you've got sort of this senior external model that we talked about, which sort of builds on that. But now you're bringing in these retired CEO types and industry types of folks, again, to partner up with the management team, right? That tends well for smaller shops in particular, right? Because you can variabilize some of these costs. You don't have a huge staff that you're paying for all the time. In the middle, you've got sort of the growth-oriented shops, right, where they tend to focus on top-line growth. So they're really focused on commercial acceleration, and their resources tend to reflect that. So it tends to be about sales, HR, IT, that kind of a thing. And then you've got sort of the specialists, right? And these are folks, for example, we tend to see this in the technology space, for example, right? Where they tend to have the generalists, but now they've also layered in a lot of these functional experts. They've got a playbook that they run over and over, and it can be incredibly detailed because you're dealing with the same types of companies over and over, right? You know what kind of functional experts you need, and you can have them on staff. And then lastly, at the far end of the spectrum is the interventionist, what we call the interventionist, right? And they'll have a lot of those same functional resources, but now you've got a sector agnostic strategy. And the advantage here is that you can handle a lot more complexity, right? So you can do big, complex carve outs that are coming out of corporates, for example. And so it just gives you a lot of additional levers to pull. But really, I think the key takeaway from an operating design perspective is really that whatever model you have, all of these can work. But the critical piece is that it's got to be aligned with your strategy, and it's got to be aligned with what you're trying to do, right? It's where those misalignments happen that you start to see some of the challenges arise. That was really one of the critical pieces here.
Yeah, the study also quantified how firms that embed operating partners more deeply tend to see fewer surprises and better returns. So, can you share more about those findings and what they mean for fund performance?
Yeah, it was interesting. So, we did quantify. We looked at the ratio, for example, of ops partners relative to the deal teams members, and what we tended to what we found, and it's probably not surprise to a lot of the ops partners out there, but what we found was that firms that have more ops partners tend to have more engagement with those deal teams. They tend to have a smoother overall engagement experience. The top quartile, in particular, of firms that have more ops partners, tend to have a greater chance of hitting their ROI targets, right? So they hit their targets about 77% of the time versus about 71% for the other quartiles. And it's also associated with a reduced incidence of seeing unforeseen risks pop up some point during the hold period.
And so
Uh,
digging more. Oh, sorry.
no,
Digging
no,
more
please go ahead.
into it. So I was gonna, you touched on ROI and value levers. Where are PE firms most confident in delivering value today, and where are they less sure? And what are the levers that consistently outperform?
Yeah, so that was one of the interesting things that we looked into in the study was what kind of levers are more consistently hitting their targets, right? So, and overall, we found that on average, firms are hitting their value creation targets about 73% of the time, right? And so then we looked at, okay, what levers tend to be more consistent, right? And so it's finance related levers tend to hit their targets more consistently, right? So it's things like capital structure optimization, for example, working capital, CapEx efficiency and allocation, finance and risk, right? Those all have a fairly high consistency in terms of how well they're hitting their targets. Then you've got sort of this next level down, and that includes things like cost takeout, some of the more operationally focused levers like talent, digital transformation, and so on. If you look at sort of overhead streamlining, for example, that hits its target ROI about 60% of the time versus that 73% overall that I talked about. And then lastly are some of these areas where, you really got to have a fairly high level of conviction to pull the trigger on, right? So things like supply chain, for example, which hits its target about half of the time. Things like add-on or bolt-on transactions, right? Which again hit their target about half of the time. ESG, those kinds of things. So it's really about sort of understanding what kind of various levers are out there, what kind of conviction you need in order to pull those levers, and again, just being able to sort of benchmark oneself against some of the peers. And then I'll just say, one of the other things that we asked here was what folks are spending on driving all of this value creation, right? And we found that on average, firms are spending about 8 cents to make a dollar, right? So 8% of the planned EBITDA lift annually is what they spend on advisors for some of these value creation initiatives. Now, some are spending less, some are spending more. It really depends on, again, going back to those 5 archetypes and what kind of model they have, right? And who you have in-house versus who you're accessing from an external perspective. But that's sort of the average.
So the study also highlights what differentiates high-performing engagements from those that fall short. And what did you find, or what did the study find makes or breaks a successful advisor engagement?
Yeah, so I think it's really a few things, right? One is around the sector expertise of the team that's doing this really jumped out as a critical piece of the puzzle, right? Firms really need to have high level of confidence that whatever operating resources that they're bringing in have strong sector expertise, right? Experience in dealing with these types of assets, and strong networks that they can leverage to solve problems. So that piece was critical. The other piece was in terms of developing a holistic plan that can stretch from the diligence phase
Mm.
through the hold period of the investment out through the exit, the ultimate exit, right? Whether that happens, 3 years down the road, 4 years down the road, 5, whatever it is, right? Having that long-term plan that can provide a roadmap for the transaction, is critically important, right? So those were really the two that kind of jumped out as being particularly important.
So, do most operating partners provide that holistic range of services, or do you find that certain operating partners might specialize in certain parts of the value chain or deal process?
Yeah, it's sort of a mix, right? And it's usually some combination of the operating partners working with the deal teams to arrive at that answer, right? Some firms, for example, when the diligence gets done, right, the operating partners who are going to be responsible for that asset during the hold period will partner up with the deal teams to, to do the diligence, to identify what levers we're going to pull and in what order, and, what kind of returns we think we can generate with that. Right. In others, they might have operating resources who were dedicated solely just to working on the diligence phase, right? And then there'll be sort of a handoff that happens after the asset is acquired to another ops teams that actually implements that, right? And what will happen, for example, is a deal team might say, okay, we think that we can get $5 million in cost savings by modernizing our IT infrastructure, for example, right? And then the ops partner who specializes in that might come in and they'll say, all right, well, we think we can get some, but we don't know that it's 5 million. We think that it's 3 million, right? And, whatever it might be. And so there's some sort of, value that's happening there as part of that diligence process. And that's a different team, than the folks who are going to be implementing it down the road. But, different firms have different approaches here. And that was one of the, reasons we wanted to do the study, is kind of to understand how that works.
Yeah. We'll share the link where our listeners can download the report at the end of our conversation. But I just wanted to ask, what kind of feedback have you had since launching the study? What have you been hearing, and what do you think you might do to explore further in the future?
Yeah, so I think we've gotten tremendous feedback from the clients with whom we shared the study, right? I think they see it as an opportunity to benchmark themselves against their peers, it's just a little bit of a sense check and being able to learn from one another, right? Across their models, their structures, the outcomes that they experience versus their peers. I'll give you an example. I was talking with a fund about the study a couple of weeks ago, and like I said, one of the things that we found was overall value creation initiatives, hit their target returns 73% of the time. And they said, well, we've run the numbers for all of our deals, and we came up with the exact same number. And so that was highly validating for us, in doing the research, but also for them, it was a proof point, right? In that they were performing in a way that was highly consistent with the market. And so, I think we've taken this out to small funds, we've taken it out to large funds. Folks are looking to get different things out of it, right? But there's a lot of depth there that they can pull from and really learn a lot of things about what the industry is, how the industry is tracking here.
So how do you see the firms who read this study using these insights uh, to drive action?
Yeah, so I think firms do a lot of this analysis on their own all the time, right? So going back to the fund that we talked to a few weeks ago, right? All the firms do this, right? They have a great sense of how their model is working, right? Where their returns are coming from. They perform these postmortems and various kinds of, performance attribution analyses, for example. And, they'll have a good sense of, okay, we applied this much leverage to the transaction, and that drove a certain amount of our return. We know that the multiple moved in the sector between when we bought it and when we sold it, and that drove a certain amount of return. We know that the value creation levers that we undertook when we owned the asset led to the rest of it, right? And they'll generally have a pretty good sense of what levers contributed to that, right? Top line growth, cost takeout, whatever it was. But what they don't necessarily have is a great sense of how that compares to their peers. And so this is an opportunity for them to achieve that. And if they find that their experiences differ dramatically from the broader market, then it's a starting point for them to at least interrogate why that might be the case. And, you can then kind of explore to what degree some kind of change might be appropriate.
So I know that you talked about the sense check you had when you shared the report with some of your clients, and the value of that qualitative feedback. Do you think that in future renditions of this study you might include more qualitative feedback, or what kind of value would that add?
Yeah, so I think as we think about sort of a version 2.0 for this, right? I think we'd probably focus on a couple of things, right? One is that I think we've captured about a third of the overall market with this study, right? And I think we would love to increase that number to get to, whatever it is, 50%, 2/3, something like that, right? And then the second piece is, really understanding from a qualitative perspective, again, this range of practices that are out there. So as part of the study, we did a small set, Phronesis did a small set on our behalf of qualitative interviews, um, really designed to pull out some of the insights behind the numbers that we were seeing and provide some additional context there. And I think that was incredibly valuable in helping to understand what we were seeing as the results came in and the charts and the graphs all started to come together. And so building on that, I think, would, just provide a whole lot more depth to what we're seeing, with some of the survey results. And we'd love to do more of that.
Well, that's great. Before we wrap up, is there anything else you'd like to share about the study with our listeners?
Yeah, I mean, just a couple of closing thoughts, I guess. I think that, in today's environment, we've obviously got much more macro volatility. We've got hold periods that are getting extended way beyond what we usually see in private equity. And so what that does is it elevates and increases the importance of these types of operational inventions, probably more than ever, right? And so understanding all of these dynamics and these different structures, it just becomes more and more important. And so we think it's the right time for this study. For folks that are interested, they can find it on our website. It's ey.com/private-equity. And they can access the study there. And, for anybody who's interested, we would be happy to share the results and have a conversation around it.
So, Pete, thank you so much for joining us. It's been a pleasure diving into the findings and hearing how this research is helping EY clients sharpen their strategies and mitigate risk. To our listeners, again, as Pete mentioned, you can download the report at ey.com/private-equity. And if you're curious how firms like EY partner with Phronesis to access hard-to-reach audiences and produce insights that shape the market, visit us at phronesis-partners.com. So until next time, thanks for listening and keep navigating with confidence. If you enjoyed this episode, please subscribe to the podcast and don't forget to follow us on social media for the latest updates and behind-the-scenes content. Stay tuned for more episodes where we will continue to explore and navigate the complex world of B2B sales and more to provide you with the insights you need to navigate your business decisions with confidence.